You do not want to miss this episode. We're going to answer all your questions about policy loans. When should I take them? When should I not take them? How do I pay them back? How do I get approved? Let's dig into it. Hi, everyone. Welcome to Control and Compound. I'm Darren Mitchell. Joining me as always, Christina Wyatt. Christina, how you doing today?
Hey, Darren, I'm doing great. I'm excited to get some of these questions answered that we hear a lot around policy loans. So I think this one's going to be very beneficial for anybody out there that has questions on policy loans, how they work. I'm excited to dig into it.
All right. Before we do that, Christina, why don't you tell people how to follow us?
Yeah, so if you're listening on your favorite podcast platform, please make sure that you subscribe and leave that 5-star review. And if you're listening or watching on YouTube, please like, subscribe, and hit that bell button so you always know when new content is coming out. And don't forget to follow us on social media at Control and Compound on Instagram and TikTok.
Okay, Christina, let's jump right into it. So my first question is, what are policy loans?
Yeah, so policy loans are how we access the cash value inside of our policies, right? We want our money to stay inside of our policy compounding. So instead of withdrawing it, we access through policy loans. And the insurance company allows us to borrow up to 90% of our cash values through policy loans that they offer, written right in the contract. 90% of the cash values they will loan to the policy holder. So that is a typical policy loan.
All right. Pretty simple. It's you call up the insurance company in our office or do it online and say, I'd like X amount of dollars, and they give it to you. Now, some of the huge benefits of this policy loan, number one, it's guaranteed. When Christina mentioned contractually, it's in the contract, 90% guarantee. They can't say, yeah, we don't want to give you 90%. We'd only like to give you 10%. No, it's contractual 90%. These loans cannot be called. So let's say you're doing a real estate investment or any investment, you lose your job, business goes south, real estate deal falls apart. They can't call this loan like a line of credit that could be called. The interest is tax deductible if you're using it for an investment and to try to earn an income, not if you want to go on vacation. What I love about them is the ability to repay the loans when you want, how you want, and if you want. That is huge flexibility. So you get all kinds of flexibility on that. It doesn't affect your creditor report. Really big for a lot of people, especially people looking at financing something, buying more real estate, buying something in their business. So it doesn't show up on a credit report, and it doesn't affect your borrowing capacity. So you can actually use these loans as a down payment when you go to purchase a piece of real estate. I've done it myself, where you borrow from the cash value, take a policy loan, then you go to the bank, get the mortgage. They say, where'd it come from? Borrowed for my policy. They go, cool, we don't consider that a loan. So pretty amazing type of loan when you break it down. It's my favorite loan in the whole world.
It's not your typical loan, eh? It's got all kinds of extra benefits, extra add-ons to it. So that was a great kind of going through the policy loan in detail and all the extras it has. Going into the next question that we're typically going to get is, well, how do I initiate one of these policy loans? How do I get one? How long does it take? Well, most of the companies do it the same way. A lot of our clients will just come directly to us. We send a 1-page form. You click to sign. Money's in your bank account between 5 to 7 business days. They're going to be able to transfer it directly into your bank account. So it's super, super simple to do it. There are no questions asked, like you said, right? You just sign requesting it. It's going to be in. Some of the insurance companies are getting even better, and you can go online and you can click on your online portal to request a policy loan. So technology is starting to catch up in the life insurance world. I hope it gets better. But it is still simple. Like our back office will process it all for you, make sure that the money's in the account for you. And then it's in your account. And when it comes to the repayment side of things, it's just as simple. Like you said, it's, you pay it back when, how, and if you want to. So you decide when you want to pay it back. You've got that full flexibility for repayment terms, but you just make the request. So some people will say, okay, well, I want to pay it back monthly, a form. I want to do a lump sum payment. Okay, we're going to send a bill payee transfer from your online banking to the insurance company to pay off that loan. We want to do a one-time withdrawal, pay that back. We can do that with some of the companies too. So I guess at the end of the day, like the most it is a form you click to sign is what it is to initiate a policy loan. I kind of made that more complicated than it had to be, didn't I, guys? But getting into the details, form, you sign, you get the loan.
Okay, I love it. And then one of the questions we always hear, Christina, is, am I paying interest to borrow my own money?
Yeah, we've talked about this one before, and no, that is not what you're doing, right? I mentioned before that our money is going to stay inside the policy and it's going to compound uninterrupted, tax free inside of the policy, right? So that's where our money is. When we take this policy loan, we're using the insurance company's money. So it's actually the participating whole life fund. We are borrowing from that fund. That is not your money at all. Your money is still inside your policy, compounding uninterrupted. So yes, we're paying interest to use somebody else's money, which is a pretty big strategy. It's used every day, other people's money. That is the exact same thing that's happening here. We're paying an interest rate so that our money can keep doing what it's doing inside the policy, earning those returns, while we multiply our dollars and have it working outside of the contract as well. So you're paying interest to use somebody else's money.
Love it. Which leads to the next ones along the same lines. When I repay the loan, am I paying myself back? And this is a one that I don't like what some of the advisors, both Canada and the U.S., how they refer to this. You're not paying yourself back is the short answer. You're not paying yourself back. So Christina just said we're actually borrowing from the participating fund. So great, you're billions of dollars in there. You're getting a loan from the fund that you're a part owner in. But when you're paying it back to that fund, and that fund is going to benefit. Now, if you have $100,000 of cash value inside a $20 billion fund, you can argue, hey, well, the fund does better, so I do better. But I don't like that. I look at that. If I own one share of Royal Bank and it's time to go get a mortgage on an income property, and the Royal Bank offers me a 10% interest rate and BMO offers me a 5% interest rate, I'm not going to say, well, you know what? I'll just choose RBC because I'm a shareholder, so I'm going to really benefit. I'm really paying myself. I don't love that. I love that we're paying it back into the fund and the fund does better. But I think sometimes people are misled that they're actually putting this money back directly into their policy. It's going into the overall fund, and you're one of the many beneficiaries of this fund.
Yeah, and I think where that a little bit of a misconception comes from as well is for anybody that read Becoming Your Own Banker by Nelson Nash, he does it a little bit differently. He's got his own spin on it, the infinite banking concept, right? And how he describes how you're paying yourself back. And what he says is you always want to repay your loans, right? But you should be repaying them at the interest rate that day. And what happens with the policy that he sets up as an example in the book is that he's got it, he's not max funding it every single year. So when we talk to our client, like, the best thing you can do with one of these policies is top it up right to the top, right? It is the best part's that additional deposit option you can put in. So you want to maximize it every single year. If you don't maximize it every single year, you do have room to add additional deposits. So what Nelson's kind of saying is, okay, we haven't maximized it every single year, so we've got some extra room there. So let's say the interest rate is 6.5%. And out there, the typical establishment or lender is charging 8%. Well, you want to still pay that policy loan back at the 8% rate, because if you pay that additional above 6.5%, it is going to your policy. You are paying yourself. So that does, like, what he's saying is correct. You're paying yourself, but you're paying yourself the portion that's above the 6.5%, right? It's not the actual interest rate. The interest is getting paid back to the fund, just like you mentioned, right? But I can see where it gets a little bit, it gets a little bit confusing. As is it that whole 6.5% or is that whole 8%? No, only if you're paying above the actual interest rate and you have room to add more cash to your policy are you paying into your policy itself. So going into interest. So this is a big question for people is the interest, right? So how, and really, at the end of the day, though, the interest doesn't matter if you're doing something great with it, but I'll keep that to the side. How is the loan interest charged? So the loan interest is calculated daily, compounded annually. So there is a compounding effect to that interest, just the same as we're seeing on the inside. So when we say if at the beginning there, when you said if you want to pay them back, you do want to pay your loans back in those early years. It is important that you repay the loans back in the early years for the long-term strategy to work, the retirement side, right? So the interest is calculated daily, compounding. annually. And the insurance companies have different interest rates. So people will say, okay, what are the interest rates? A couple of them do prime +2 right now. Another one does, it's always going to be above their dividend. So if their dividend 6.4, the loan rate 6.5. I never encourage people to choose a company based on their interest rate because the interest rate is not contractual. That interest rate can change. So, do check out what the interest rate is when you're shopping for interest rates, like kind of what you just said. If you can get a lower interest rate somewhere else, you might not want to use the policy loan, but there could be other reasons you want to use it, but not contractual. So it can change. That interest rate can change, and it's calculated in different ways.
Okay, but I get a loan. What can I do with the loan?
Good question. So you can do whatever you want with a loan. So there's no questions asked. We've talked about that, right? So when the loan hits your bank account, it's no different than cash in your bank account. You do exactly what you want to do with it. Now, if you want to be able to write off the interest, like you mentioned like when you mentioned before, you do need to invest it, right? You invest it, or if you're a corporate business owner, you can use it for business expenses, but you want to be investing it to make returns to write it off, but you don't have to. Right? They're not going to question you. Nobody's asking you what you're doing with this loan. They're just going to deposit it in the account. So, there's the answer to that is whatever you want, you can do with your policy loan. Okay. So going back to the next one that I have, and this one I think we're going to have to elaborate on a little bit more, is should I always use policy loans and never a bank loan? So up to this point, we have been talking about policy loans that we take directly through the insurance company. There is another way to access the cash values in our policies, and it is through a third-party lender. So there's lenders out there that actually specialize in these lines of credit and these products to be able to access the cash, and they still loan 90% on them. Sometimes they actually even have better interest rates when you're looking at them and checking them out. And most definitely at some point in time, you're probably going to want to use a third party or a collateral loan through another lender instead of these policy loans. So Darren, I want to dig into this a bit more, starting with, why would we want to look at a third party lender and how that all kind of plays out?
Sure. I'll give you the short answer and then the really long answer.
Okay.
So the short answer is take a bank loan if your loan is higher than your ACB. Now, again, not a lot of people are going to fully grasp all that, but basically, when you go to take a loan, if your loan is higher than your adjusted cost base, and we're going to break down adjusted cost base and how it's calculated, then you're going to want to take a bank loan. In general terms, it's usually the first 10 or 20 years, policy loans are going to fulfill the needs for almost all clients. And in the later years, we're going to talk about bank loans, okay? And the reason, just one note on the bank loans, why do these banks want to loan money? Because insurance is the greatest thing to loan money against. It's guaranteed not to go down, guaranteed to go up, 150-year track record of paying a dividend. And if you die, there's a big death benefit. So the financial institutions love loaning against this. It's a much safer loan because you have much safer collateral than, say, a real estate property. That's why they're loaning 75, 80% on real estate, and they're loaning 90% on this because it's a much better loan. But let's talk about adjusted cost base for a second and kind of dig into what it is. So if I buy a property for $400,000, my adjusted cost base is $400,000. So if I sell that property down the road for $500,000, I don't pay tax on $500,000. I only pay the tax on the amount above the $400,000. Now that adjusted cost base is my cost base plus any additional deposits or minus any money I took out. For instance, if I bought a $400,000 property and I had $10,000 of legal fees to close on that property, well, now my adjusted cost base is $410,000. So if I were to sell that property, I'd only pay tax above the $410,000. Okay, so above the $410,000. Same in the stock market. If I buy $100,000 of stock portfolio from my broker and I sell that, I only pay tax above the $100,000. But what about the minuses for cost basis? So let's say I went to my stockbroker and I said, listen, here's $100,000 for investments in a stock portfolio. And next month you said, listen, I need $250 to pay my car insurance. And your stockbroker sent you a check for $250 and you paid your car insurance. Well, now if you were to sell your stock portfolio, your ACB is only 99,750. So in other words, 100,000 minus what you took out. And if you told your stockbroker, why don't you take the 250 out, sell it, and pay my car insurance for me? It doesn't matter if you actually saw the money, it was being used on your behalf, so your ACB decreases. So the reason I tell that story is when we look at insurance, it's calculated in a very similar way. So if you put $25,000 into a policy, and I'm going to use an example of a 35-year-old here. A 35-year-old puts $25,000 a year into an insurance policy. Death benefits around $500,000. What's his adjusted cost base? His adjusted cost base is his deposits minus the NCPI. NCPI stands for net cost of pure insurance. Easiest way to think of NCPI is it's the pure mortality risk, or what a 1-year term insurance contract would be. So in other words, the insurance company would say, how much premium to cover a healthy 35-year-old for $500,000 of death benefit for 1 year, and at the end of 1 year, that coverage expires. That's a pretty low risk thing. So it's only $250. So that person's, in that example, the 35-year-old, his adjusted cost base is $25,000 minus, it's actually $225 is the NCPI. So his adjusted cost base is the $24,775. So if he were to cancel his insurance contract and what he received was higher than his ACB, he'd pay a little tax. Now he's not going to have a higher cash value than the $25,000 deposit in year one. But when you go to get a loan, they're going to kind of look at it the same way. If your loan exceeds your ACB, so this guy's ACB year one went down $225. Year two, it goes down $286. So after 2 years, he's put in 50 minus ACB or minus the net cost of pure insurance. He's got like 49,500 roughly. Okay. So we play that out. The policy loans are going to work great. But if we fast forward, say to year 10, now we're in a situation where our cash value is 285,000 and our ACB is only 244.
Yeah, because we've only put 250 in at this point, right? So you've got 250 is all you put in, plus you're able
250 you put in, but your adjusted cost base is 245.
Yeah.
Okay. But your cash value is higher than you put in. So if this person went and got a loan of 200,000, policy loan works great, no tax payable. 240, no problem. But if he wanted to get a $250,000 loan against this policy, his ACB is only 245. So of that 250 loan, 245 would be tax free, and he would pay tax on the difference, the $5,000. Okay, so he pays the tax on that 5,000. Same if you were to cancel or to take the loan above the ACB, there's going to be a taxable event. What happens next year when he repays that loan? Well, he gets that tax back. So it's really a wash, right? And most people aren't taking out the max loan to get over their adjusted cost base. But in the later years, as your cash value grows exponentially, now you're going to be in a point you have way more cash than what you put in, and way more cash than what you put in less the cost of pure insurance. So you could reach a point where you say, great, I have $1 million of cash value, but my ACB is 600,000. Well, now if I want to go take an $800,000 loan, I'm going to have a $200,000 taxable event that I can get back when I pay the loan. But to avoid all that, we just say, okay, when you're taking a loan higher than your ACB, in other words, a taxable event, we're not going to do a policy loan. We're going to do a bank loan. And it's going to be almost the same way to get a bank loan, depending upon your age and the amount of the policy. They're really simple to get these bank loans because the banks know they have the perfect collateral. So that's really where we want to bring in the bank loans when we're going to be in a taxable situation, or in retirement, typically where we're going to have a long-term outstanding loan, because typically we can get a little better interest rates with those bank loans. Interest rates really don't matter half a point either way. When you're borrowing 50 grand for a year or two, you're writing off the interest. But if you're borrowing, $3 million over 30 years of your retirement, then that little bit of interest rate does matter. So, I mean, I know a lot of people aren't going to follow everything I said here, but the underlying thing I need you to understand is you will never pay tax on a loan because you will do a policy loan whenever a policy loan makes sense. And when a policy loan doesn't make sense and there's going to be a taxable event, we're going to do a bank loan. So that was a long explanation to say you're not going to pay tax on your loan. And that goes back to what we specialize in, right? Like our firm tracks all this for our clients. We know exactly where you should get the loan every time you get a loan, and we tell you where to get your loan. We tell you just to be cautious of this loan in this many years is going to be approaching this amount that may be taxable. So we've never had a client pay any tax on a loan because we manage it, because we understand the product, because we specialize in this.
Yeah, absolutely. That was great. That was great. And a lot of questions do pop up about ACB and how are policy loans taxable. And I think that really, it gave us a lot of the information that you need to understand it. Because at the end of the day, if you understand it and you do it correctly, no, you don't have to pay tax, right? That's so important. Why we educate on how these policies work and how the loans work, so that you can do it correctly and you don't end up paying tax on it. So that was awesome. Thanks, Darren.
All right, Christy, anything else on policy loans? I think we covered a lot here today.
No, I think this was awesome. But if anybody does have additional questions, drop them in the comments below. We're always happy to answer any questions from our listeners. And we're so happy that you joined us today. Thanks, guys.
All right. Keep getting those tax-free loans. Have a great day.
Thanks for watching this episode of Control and Compound. Don't forget to subscribe and hit that bell button so you never miss a new episode. And if you're ready to learn more, head to our website, controlandcompound.com. The link's below.